Ever considered how real estate can be a gold mine in low-interest markets? Let's start by understanding what this means. Real estate, as we know it, is one of the most tangible and profitable forms of investment. It's a market that's always evolving, always dynamic. Now let's talk about low-interest markets. These are essentially economic environments where the cost of borrowing is relatively low. In such markets, real estate investment tends to flourish. Why, you ask? Well, it's quite simple. Lower interest rates mean lower mortgage rates, and lower mortgage rates mean more people are likely to buy homes, pushing up demand and consequently property prices. This creates a favorable environment for investors looking to buy properties and sell them at a profit. But here's where the enigma comes in. One might wonder, how can this be profitable? Let's delve into a case study to understand this better. Scene script. Think about the US, a prime example of a low-interest market. What makes it a hotbed for real estate profitability? Let's dive into a case that provides a clear picture of this. We'll take a look at the housing boom of the early 2000s, a period when the Federal Reserve had slashed interest rates to historic lows. This was done to stimulate the economy after the dot-com bust. Low interest rates, you see, make borrowing cheaper. This is particularly relevant in the real estate sector, where most purchases are made through loans, or what we call mortgages. When the interest rates dropped, it meant that potential homeowners were able to borrow money at a cheaper rate. This in turn encouraged more people to take out mortgages, leading to an increase in demand for homes. And what happens when demand goes up? Prices follow suit. So the real estate market experienced a significant surge in property values. Homeowners saw their home equity rise, and real estate investors enjoyed substantial returns on their investments. Consequently, the low-interest environment of the early 2000s turned the US real estate market into a very profitable venture. But let's not forget about the real estate brokers and agents who also reaped the benefits of this boom. They earned hefty commissions as more transactions were made in the market. The lower the interest rates, the more homes were sold, and the higher their earnings climbed. However, it's important to note that low interest rates are not the only factor that contributes to real estate profitability. Other elements such as location, market conditions, and property type also play a crucial role. But when all these factors align in a low-interest market, like in the US during the housing boom, real estate can indeed be a highly profitable investment. As we see from this case, low-interest markets can indeed turn real estate into a profitable venture. But is this applicable to all markets? So, what happens in high-interest markets? Can real estate still be profitable? Let's dive in. In high-interest markets, the challenges of investing in real estate become a bit more pronounced. Why? Well, high interest rates make mortgages more expensive. This means that potential buyers may struggle to secure the necessary funding, or they might decide that the cost is just too high. This, in turn, can discourage investment in real estate. If fewer people are buying, property prices may stagnate or even decline. And for those who do decide to invest, the higher mortgage payments can eat into their rental income or potential profits from a sale. As a result, the returns on real estate investments can be significantly lower in high-interest markets. So, while it's not impossible to make a profit in these markets, it can certainly be more difficult. Evidently, high-interest markets present a different scenario. But overall, what have we learned? Interest rates and real estate profitability seem to dance a delicate tango. Throughout this video, we've explored how these two factors influence each other in the grand stage of the real estate market. Low interest rates in markets such as the United States become an enticing melody, drawing investors towards the dance floor. They encourage more borrowing, fueling increased demand for property and consequently, higher property values. This symphony of events often leads to greater profitability in the real estate sector. On the contrary, the high interest rates in other markets strike a discordant note. They make borrowing more expensive, slowing the tempo of property demand, dampening property values, and ultimately, restraining profitability. These dynamics between interest rates and real estate profitability form a complex choreography that every investor must learn to navigate. Remember, the real estate market can be a goldmine, but only if you know where and when to dig.